Today, I'm going to talk about one of my favorite high yield dividend stocks, and that's MPLX. This company has a rare combination of high dividend yield and high dividend growth. In my personal dividend stock portfolio, I own 330 shares or units, more on that later, which is currently valued at $19,950. This pays out $1,421 in annual dividend income. In fact, I have $355 set to be paid to me on August 14th, and I will be reinvesting that to earn more shares in the company. And despite the stock price at all-time highs and going up 12.16% on the year, the dividend yield is still 7.13%, and this is before their upcoming dividend increase. And you can see the crazy high dividend growth this company has. Their most recent increase was 12.5%. The one prior was 12.5%. And the two before that were just under 10% each. And this is a company with a 7, 8, and even depending on when you bought it, a 9% dividend yield. But here's the kicker. I just listened to their latest earnings call in preparation for this video, and the CEO of the company said that in 2026, they're expecting another 12.5% distribution or dividend raise, and in 2027, another 12.5% raise. And they mentioned that they are committed to continued distribution growth in the future. And as someone who looks at a lot of dividend-paying stocks, that is a rare thing to see, especially with this high of a yield. MPLX is a midstream oil and gas company in the energy sector. It's currently valued at a market cap of $61 billion. But before you get too excited, I'm going to give you the ugly part straight up. It has to do with these two letters, LP. This company is a master limited partnership, so you will get a K1 during your tax season. And for a lot of investors, that just eliminates it completely because they don't want to deal with another tax form. However, as someone who bought MPLX last year and just went through their first tax season with it, I didn't have a problem with the form, and it was actually much more simple than some of the other K1s I've had in the past. So today I'm going to give you a full deep dive into MPLX and their latest earnings report. I'll explain what the business actually does. I'll go over all their core financials, and then I'll give my thoughts on whether it's still a buy right now, even at its all-time high in stock price. And it's actually an interesting question because based on historic multiples that the company has traded at, it does look like it's on the expensive side. But when you try to calculate the intrinsic value of the company, it looks like it might still be undervalued. So with that said, let's roll the intro and get into today's MPLX stock analysis.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach. This is Dividend Data. You should leave a like and subscribe to the channel if you enjoy the video. Throughout, I'll be using the next generation version of dividenddata.com, which just launched a few weeks ago. It's gotten great user feedback so far. You can scan the QR code in the corner if you want to try it out and follow along. Also, by the way, guys, we finally have a dark mode on the website. Let me know what you like also for the videos. What's easier to see on the videos? I like the dark mode, especially if I'm using it at night, but I find that the light mode might be easier to see in the videos. Put your comment below on that, but let's just dive into this MPLX stock analysis. So this is a pretty interesting company, and I think these midstream assets are pretty underrated. If you just look at the all-time stock price chart, it doesn't look that impressive. Since going public in 2012, it has a 5.96% compound annual growth rate. That's for the stock price. And you can see in its first few years, it was really overvalued, and it still has never hit those peaks. However, if you've analyzed other midstream oil and gas stocks, like EPD as an example, this was a sector-wide phenomena, and you can see that EPD also was overvalued in the same time period, sold off and has never hit those peaks. However, the shareholder returns, because the distribution, the dividend is such a big factor here. If we look at the total return for MPLX stock, it shows a dramatically different story. Since its IPO, which wasn't even a good time to buy the stock, it's had a 500% total return, which is a 14% compound annual growth rate. And 386% of that return is from reinvested dividends. So dividends are a huge part of your return here. And that will go into how I calculate the intrinsic value of MPLX as an investment. But there was actually a time that was a crazy buy for MPLX, and that was back in 2020. If you bought near the low in March 2020 for this stock, it had sold off a ton. And from those lows, the stock is up 864% in terms of total return, which is a 42.77% compound annual growth rate. And even if you bought coming out of that in 2021, the stock was still undervalued. If we look at the 5-year, which goes back to August 2021, the stock has a 238% total return with a 27.63% compound annual growth rate, beating the market by a wide margin. And it's doing that reliably with a high dividend yield along the way. But the question is whether these kind of returns are likely going forward. Over the past year, the stock's generated a 26.88% total return with 9.6% from dividends reinvested. I want to provide some more context here about how great of a buying opportunity 2020 and 2021 was for this company. And I didn't even know it existed. In hindsight, if I could go back then with my knowledge, I would have loaded up on this company. During that year, on its cheapest day in the sell-off, the stock was trading at a 32.82% forward-looking dividend yield. And from that point on, the company raised their dividend 111%. And even if you didn't get it at the peak, which is unlikely, no one's really going to get it at the peak. Throughout that year, there was tons of time to buy it in the teens of 15% dividend yield. Even going into 2021, it was a 16% yield. Now, if you follow the energy sector, you know there was tons of opportunities in that year because demand fell off a cliff. We were in the COVID shutdown. The world was shutting down. Oil prices were plummeting. Oil briefly went negative for a period of time, but the world opened up and everything rebounded. And there's been 2 periods of actually extremely high oil prices along the way and very profitable levels for a number of years. But there are times where the market can just act irrationally with short-term thinking. And this is why it's important to have a prepared mind. And a big part of investing is just continuous learning and then hoping you can have the pattern recognition for when an opportunity is actually available. And then, of course, just your consistent behaviors that you can have on an ongoing basis. As an individual, you can't always be waiting and you'll be dollar cost averaging and building out your investments, growing your personal income. So today I'm going to do a little financial overview of MPLX. I'll go over their latest earnings report. I'll explain why the dividend is going to continue growing, at least in the foreseeable future. And then I'll explain whether or not the stock is expensive right now or if the company is still undervalued. So first, let's just take a look at the earnings. So just earlier this week, they reported their latest quarter. That was $1.06 for the quarter, which is up 2.91% year over year. And over the trailing 12 months, the company's generated $4.65 in earnings per share, which is up 10.45% year over year. This is higher than their annual dividend. You can see their earnings payout ratio for 2025 was covered at 81%, and their free cash flow payout ratio for 2025 was 98%. But these midstream oil and gas partnerships are a little different in the metrics you use. In these reports, they talk a lot about distributable cash flow. They talk about EBITDA a lot in this business. They have different forms of CapEx even. They talk about maintenance CapEx and growth CapEx. So when analyzing a company like MPLX, I would always look towards their actual reporting results and their earnings. And I keep an eye on that distributable cash flow number they're talking about because the traditional earnings per share payout ratio really does not tell the full story here with the stock like MPLX. It was unsustainable for a number of years, yet it continued growing that payment and reliably paying it for all that time. So I would not let an 81% or a 98% free cash flow payout ratio really lead you to believe that the dividend may be unsustainable or slow growth soon, especially when you consider they just did back-to-back 12.5% raises and just said in their latest call that they're expecting 2 more 12.5% raises over the next 2 years. So let's get into some highlights from their second quarter 2026 earnings. But first, let me just give you a quick overview of what the business actually does, especially if you haven't been studying midstream oil and gas. I really just dove into it a lot over the past year and a half more, and I find it to be a pretty interesting layer of infrastructure in a pretty important industry. So fundamentally, they do transportation, storage, and distribution services. So MPLX and other midstream businesses, they are a fundamental layer of the whole oil and gas energy sector. They provide transportation, storage, and distribution services across the entire value chain. They are the link between the producers to the refineries, the processing plants, the storage, and up through to the end market. And on their company's investor relations page, it says that they have 100 years of midstream experience. And that's correct. The history is actually really interesting. So MPLX is the midstream company for Marathon Petroleum, which is also a publicly traded company, MPC. This is the oil producer associated with MPLX. If you just watched the HESM video I did, Chevron is the producer now associated with HESM and those assets. Marathon Petroleum owns a large equity stake in MPLX. In fact, it's approximately 64% of MPLX. But going back to that whole 100 years comment, Marathon Petroleum is an offshoot of Standard Oil, the most powerful oil company in history. So a lot of the history, locations, and infrastructure goes back to that time period. And Marathon Petroleum has a lot of their assets in the Midwest. Ohio is their big state. And you can see they basically have networks connecting the entire country up in the Great Lakes, Ohio, Michigan. And they also have huge assets down in Texas and Louisiana. They have tons of port control, and they actually are a large maritime shipper. They own tons of large marine ships that are used to export LNG and crude oil. And if you've been following politics, I'm sure that business is booming down there in Texas for that. They own pipelines across the country, taking Marathon Petroleum's oil and gas and piping it down to these exports and processing plants all over the country. They also have assets in the Permian and Delaware Basin. They own natural gas processing complexes and pipelines to bring them to market. This company owns a ton of infrastructure throughout the country. And their main business segments are in crude oil and products logistics. So that's also all the petroleum products that are refined from that. It includes the marine business, pipelines, terminals, rail facilities, storage caverns, and refining logistics. Then they also have a natural gas and NGL services company. This is gathering, processing, transportation, as well as the fractionation, storage, transportation, and marketing of natural gas liquids. And then they also own a bunch of pipelines in crude oil, natural gas, and natural gas liquids that they have tariffs on. So basically like a fee, a tax they get for owning or owning part of a pipeline. So I hope you enjoyed that little dive into their background. Now I'll go over some of the more interesting things I found in their earnings report. So first I'll start with the breakdown of their different segments. So they have the crude oil and the natural gas businesses. Crude oil is the larger business of the two. However, it is the slower growth one that they're not investing as much in right now, which makes sense because a lot of the growth opportunity is in natural gas and natural gas liquids. So you can see in the second quarter of 2026, crude oil was $1.16 billion. This is an adjusted EBITDA attributable to MPLX, and natural gas was $614 million in that quarter. However, if we look at the growth rates, the growth rate is much higher in natural gas. You can see adjusted EBITDA in the natural gas segment grew 11.2% year over year. And the key thing is that over 90% of the growth capital they're investing is investments in the natural gas and natural gas liquid services. And they are putting a ton of investment in this category. That includes organic and inorganic. Here you can see the projects that they have in 2026, which are already underway, and their planned projects in 2027 and beyond. And because they're investing a lot in growth capital, I think that's why they're confident in being able to raise their distributions in the coming years. And what they said on their earnings call is that the first 2 quarters of 2026 were much lighter, and they expect the second 2 quarters to be much stronger growth year over year. I forget which one they mentioned. It might have been the Secretariat 1 gas processing plant that just opened. And they have another asset that is supposed to open later this year. Oh, here you can see they have a slide on it, of course. Positioned in the second half, weighted growth in 2026. Lots of stuff happening in the fourth quarter. Expansion of a big pipeline they own. Expansion in the Delaware sour gas treating facility. And they're basically building a fully integrated natural gas system in the Permian Basin. And they see a lot of opportunity there. There's tons of growth, obviously, domestically for use, and then also exporting internationally. That's a big political trade thing going on right now, trying to export more LNG. So on the earnings call, they feel very confident in demand. They mentioned it. And they even specifically called out the fact that data centers are using a lot of natural gas now, that they feel very strong about domestic natural gas demand well into the future. And I would expect them to continue investing and being one of the big suppliers in the infrastructure layer for natural gas. Meanwhile, their crude oil business is just pumping out cash flow for them, and they're barely investing in expanding it. And as natural gas becomes a larger percentage of the business at MPLX, you should see the overall growth accelerate as well. But I personally, I'm not negative on the demand for crude oil and petroleum products long term. I think this is going to be with us for many, many decades to come. And frankly, it's just an important part of like human civilization. So here you can see their recent financial performance. Adjusted EBITDA has grown at 6.7% compound annual growth rate. This is going back to 2022. Distributable cash flow has grown at 6.1% compound annual growth rate at $5.8 billion in 2025. And you can see their distribution has grown at an 11.6% compound annual growth rate. You can see in the second quarter of 2026, they currently have a 3.7x total debt to adjusted EBITDA ratio. This is higher than the example of HESM that I showed earlier, but this company is larger and also investing in many more categories as well. And here you can see the examples of different CapEx that I mentioned earlier, how they list out their growth CapEx and maintenance CapEx. I thought that was pretty interesting when I was looking through this earlier. So you can see this quarter, they had $874 million in total growth CapEx compared to $406 million in the prior year. And you can see that maintenance CapEx is lower at $67 million, but up from $44 million in the year prior. And I thought that was an interesting mental lens that you should also just be thinking about as you're analyzing the broader market, other stocks. And there's actually a Bill Ackman post about this, like earlier this year, where he's talking about growth CapEx as it relates to AI data centers. And I do think it's important to mention that that is in the growth CapEx category, and they are investing in that new infrastructure in a new category to bring on new revenue compared to just replacing your existing assets that you're not necessarily monetizing. I would consider that to be the cost of just doing business versus growth CapEx being investment into a growth opportunity. I think it's just an important frame you should always have in mind. But is MPLX a good buy today? Is it undervalued? Is it overvalued? I'll give you a few different ways to look at it, but I'm diving into that question right now. And throughout, I'm going to be using some of our pro tools over on dividenddata.com. That includes the value graph, the intrinsic value calculators, analyst estimates, analyst price targets, and a ton of other great features. So if you want to use the same stock research tools that I'm using, it's all available at dividenddata.com. Currently, you can get 50% off pro membership to celebrate the launch of our new tool. You can be a founding member of the tool. So click the link in the description and pin comment or scan that QR code in the bottom right corner and you can get 50% off every single year. You get to lock in that price for life. And if the tool helps you find just one better investment, then it way more than pays for itself. With that said, let's get right into it. So this is the value graph tool. You can look at all these different metrics, whether it's earnings per share, dividend, free cash flow, operating cash flow, revenue, EBITDA, even book value. And you can basically see each company and its fundamentals mapped out over time. And you can see the multiple that it typically trades at. So right now we're looking at the typical PE multiple. You can see over the past year, it's ranged from 9.1 to 13.01. This is for adjusted earnings per share. The median multiple over the past 5 years is 10.9. So what we have here is the price versus fair value. And in this example, we're calculating fair value by taking whatever the adjusted earnings per share is at that time and multiplying it by the median PE multiple that it trades at, assuming that the median is a fair price. And at any time it's trading below the median would be a discount. And in the examples where it's trading above the median, it would be considered expensive based on that financial metric compared to how it's historically traded. Now, one thing we'll notice here is that the fair value is going up over time. And that's because the fundamentals of MPLX are improving over time. So yes, you're trying to buy in while it's at a discount. Maybe you have a little margin of safety. But in general, you also want a business where the fair value, the intrinsic value of the company goes up over time, especially if it's a long-term holding. So as you can see right here, the current adjusted earnings per share over the trailing 12 months is $4.65 for MPLX. The stock is currently trading at a 12.99 P ratio based on that number. However, over the past 5 years, the median multiple is 10.9. So if the company reverts to that 10.9 multiple, that would give an implied fair value of $50.69. In that case, the stock price would be 16.1% overvalued. That would be the downside from here if you assume that the median should be the fair value. However, this could be an example of a stock where that could not be the case. And I'll dive into that as I dive into the intrinsic value of the company later, calculated with things like the dividend discount model, discounted cash flow valuations, because I think there's certainly an argument that the stock has been undervalued and cheap for the past 5 years. And that's part of the reason why it's had great returns. And even today, as it hits an all-time high in price, it might still be undervalued. But let's continue with the value graph here. Right now we're looking at the dividend. It's currently set to the trailing 12 months dividend, which is the same as the forward looking right now because the past 4 quarters, we haven't had that most recent dividend increase put out yet. So the trailing 12 months dividend yield is 7.13%. The median over the past 5 years has been 8.04%. So if we click that, that'll set the target yield up here. And if it returns to an 8.04% dividend yield, that would imply a fair value of $53.56, which would be 11% downside on the stock price from today. And you can see based on this dividend-focused value graph, the stock has appeared expensive or trading above fair value, and really going back since 2024. But as I mentioned earlier, the stock has had good returns in that time. And I think a big part of that is just the fact that the fair value is growing. These 12.5% distribution hikes have been awesome. And also the fact that you're buying a stock at an 8% yield and reinvesting those dividends, that inherently has a pretty good total return. And for the rest of these metrics, it's pretty much the same thing. Free cash flow, operating cash flow, revenue, they all look expensive relative to the median multiple over the past 5 years. Even EBITDA looks expensive. But in the grand scheme of things, MPLX might still be cheap. These are still all low multiples. After all, we're talking about an 11x multiple compared to a median of a 9.9 multiple. That's not a huge range. So let's dive into that. Today, we're going to take a look at the intrinsic value calculator on dividenddata.com. We'll look up MPLX, and we have a few different models we could run here. We have the dividend discount model, or DDM. This is considered to be one of the most conservative ways to value a stock because it's purely basing the value of the company based on the distributions, the dividends that they pay you. And then you have variations of the discounted cash flow. We have our advanced DCF, a simple DCF calculator, and this is valuing a company based on the free cash flow they'll generate you in the coming years, discounted back to a present value. And then I even have the Ben Graham formula. But today I want to look at the dividend discount model primarily. And it pre-fills with all the stock information depending on what you selected. But there are some key things that I want to change here with this assumption. First off, we're assuming a 5-year compound annual growth rate of 9.38%. And if they can hit that over the long run, the stock would definitely be undervalued. So right now we have this $4.31 per share annual forward-looking dividend. Again, they're about to have a 12.5% increase from here. So we're going to see a lot of short-term growth in that number going up. We have the assumed dividend growth rate. This would be one of the variables you could control. We have the required rate of return or your discount rate. That's set at 10%, assuming you basically want to match what the S&P 500 does on average. But you could be more conservative. You could have that at 13%, maybe even 15%. Growing at 15% actually has a pretty significant compounding advantage over 10%, even though it doesn't seem like a big difference. And then you also have the projection years that you can control. I might bring that down to 30 for this example. So you can see here, just with these changes in assumption, a 15% required return projected over 30 years, 9.38% dividend growth. That would give the company an intrinsic value of $65.23, which is 7.95% upside from here. However, this is still an aggressive growth rate. I don't want to assume that going forward, even though they'll probably do that in the short term. Let's say you put it at 7%. And now if you're on that 15% required return, you're getting an intrinsic value of $51. But let's say you want a 13% total return. And this is a number I think a lot of dividend investors would be pretty happy with. Assuming a 7% growth rate, that would give it an intrinsic value of $61.90. This is purely based on the dividends the company is going to pay you. That would be 2.46% upside from here. And a required return of 10%, which I kind of just mentally use as my baseline, and I compare most things just with a 10% discount rate. This gives the company an intrinsic value of $86.66. That'd be 43% upside from here. That's a pretty strong margin of safety. And if we're on that 10% example, and we assume a 5% dividend growth rate, still an intrinsic value of $68.09, 12.7% upside from here. So I definitely think there's an argument that MPLX is still undervalued, and there's a pretty good margin of safety to get some strong compounding returns. But now let's take a look at the advanced discount cash flow calculator. And this one's actually a pretty interesting tool. It pre-fills with all the financial data, and you can edit all the key assumptions in the coming years. And you can value it based on a multiple of price to free cash flow that would be trading at the end of that simulation, or at a perpetuity growth rate you would assume going forward. Now I'll show you some of the changes I made here. The baseline assumption was messed up in the CapEx to revenue. So I adjusted that so that you could see it's more like what it was in the most recent year, $1.8 billion. I made it so then 2026 would be 1.9, then $2 billion, and then kind of average out around 1.7, 1.8. The initial pre-filled version was much lower that I don't think will prove to be accurate. And in general, I always want to be more conservative with any of these kind of estimates. Here you can see other key assumptions would be the revenue growth, 8%, 6.7%, 5%. Then it levels out at 0, but this is what it does by default. So let's add in like 3 and 3%. Again, we're just being conservative here. So you can see here, if you assume that it trades at a price to free cash flow ratio of 13.71, that would imply an intrinsic value of $86.21, which would be 42% upside from here. If we lower that down to a 10 price to free cash flow ratio, that brings the intrinsic value to $63.29, which would be 4.76% upside from here. And if it goes back down to the median of 8.58, I have to check what the default setting here is for this distribution. I don't know whether it's 10 years or all time, but you can see at 8.58 median multiple gives an intrinsic value of $54.52. That would be 9.7% downside from here. If you assume perpetuity growth rate of 2.5%, intrinsic value would be much higher, 86.2%. And again, we're talking about low multiples here in this other example. These are not high multiples to pay for a company. If we assume a 1% perpetuity growth rate, intrinsic value of $66.75, 10% upside from here. But in general, with MPLX and HESM, these kind of midstream oil and gas stocks that have a high dividend yield, and really any high dividend yield stock that's slightly lower growth, I always look towards the dividend discount model to help me do a valuation on the stock, because with those kinds of companies, the big part of the return is going to be from the dividend anyways. So you want to make sure you get in at a price that makes sense. And it definitely went into my logic for why I was buying HESM and MPLX in the year prior. It's worked out pretty well so far. MPLX, I have a 32% total return. Again, this was purchased in 2025. Most of this stake, I've reinvested dividends in that time. HESM, I have a 24.97% total return. All of that purchased mostly in fall 2025. I've reinvested my dividends. That's 102 shares in that case of HESM. And they've been a huge part of my dividend income focused strategy in this dividend growth account. And I think it's been a nice complement to my lower yield big tech companies that I owned. So I'm glad that I discovered MPLX. I think it's a high quality company. I view it as a staple of my personal dividend growth stock portfolio. And my current plan is to reinvest dividends and probably dollar cost average in over the long run. I built up a good amount of those positions, and I think I only bought a little bit in early 2026, but I think over the next year or so, next couple years, I'll be adding a lot more to these positions. So if you're watching these videos, back off. I don't want you to buy. Save it for me. I'm just joking. It doesn't really matter. But I hope you enjoyed this analysis. Make sure to leave a like, comment, and subscribe to the channel if you want to see future stock analysis and portfolio update videos. Put in the comments any other companies you're interested in, whether you want my opinions on other midstream oil and gas stocks like Energy Transfer or EPD. Make sure you go watch my HESM stock analysis video I put out earlier this week if you haven't already. And if you're interested in the stock analysis tools I was showing throughout, it's all available at dividenddata.com. We have a 50% off sale where you can lock in half off annual membership. And if the tool helps you find just one better investment, way more than pays for itself. So with that said, thanks for watching, and I'll see you in the next video.